Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, a major automaker seems to be pausing on Canadian expansion. Is that the start of a trend? And close up with business leaders navigating the reality of tariffs. Plus, it's not your imagination. Housing affordability in Canada really is the worst. That's all ahead. First, for the week that was in business, it's time for the briefs. Canadian consumer confidence is being hit by economic uncertainty. The Bloomberg Nanos Confidence Survey revealed that more than two-thirds of Canadians see economic weakness in the next 6 months, with the outlook lowest on Ontario and BC, both expected to be hard hit by any tariffs. Meanwhile, the Conference Board's index of consumer confidence fell the most in a year and a half, as more than one-third of those surveyed saw a worsening of their own finances. President Trump confirmed fears that tariffs will be put on Canadian goods as of next week. The plan for a 25% import tax on most imports from Canada starting March 4th. Energy exports could see a 10% tariff. The federal government said it is ready to impose retaliatory tariffs on $155 billion of American products arriving in Canada. Economists agree that the tariffs, as described, would likely plunge Canada into a recession. It's a mixed picture for borrowers as interest rates decline. Equifax Canada said this week that while some benefit from lower rates, there are still signs of a struggle. In Ontario, more than 11,000 mortgages recorded a missed payment at the end of last year as consumer debt continues to climb and add stress to households. Average non-mortgage debt per consumer hit $21,931 by the end of the year. That is above pre-pandemic levels. Canada's biggest banks are bracing for fallouts from tariffs. Performance at the lenders varied, but one big theme was that those that profit from capital markets are doing well, and increasing amounts are being set aside for loans that go sour. More than 200 Canadian tech executives have written an open letter challenging others in the tech industry not to give up on diversity programs. It comes after a large wave of corporations in the U.S. have backed off formal DEI policies, and a perception that Canada's largest tech firm, Shopify, is similarly abandoning DEI efforts. It took less than a week for Montreal trucking firm TFI International to get the message. Moving its headquarters south of the border would be met with stiff resistance. TFI had argued that 70% of its operations are in the U.S., as well as about half of its investors. Still, one major investor holds some clout. Quebec pension fund Caisse de Dépôt was sharply critical of the move. And those are your business briefs. Tariffs are set to kick off as soon as next week. The auto sector, of course, will feel the sting in steel and aluminum. And in the face of a changing trade reality, it seems some automakers may be rethinking their strategy. Flavio Volpe is president of the Automotive Parts Manufacturers Association. Flavio, thanks for being with us.
Thanks for having me on.
I'm referring, of course, to what appears to be a stall in Stellantis' plans to expand here. I saw that and I worried, Flavio, that it's the beginning of a stall in growth plans by all of the automakers, that they'll see Canada as a risky place. What's your thought on what lies ahead?
I think specifically on this piece, the more important dynamic they're responding to is not the tariff threat, but the fact that they were planning to build fully electric vehicles here. And Trump and his administration are backing off the purchase incentives in the U.S., as well as some of the supports in manufacturing there. I think it's important and material that the company has said, and it's a publicly traded company, saying, look, we're still committed to the investment, but we do need to look at the product plan. For suppliers, the most important thing is volume. Don't put a dud in there. If you need to pause for another year or less to figure it out, okay, as long as we have robust product.
So from a supply chain point of view, for now at least, do you feel as though the business model is safe, or will we see a gradual movement of the manufacturers south of the border to avoid some of these tariff issues?
Well, I think automotive investments have a longer outlook than to be that worried. But I do think anybody that is contemplating a new investment in North America is suddenly looking at their U.S. option for a greenfield investment at the top of the list. The one holdback there is that what the Trump administration is doing to market confidence, consumer confidence in that space. Tariffs will raise the price for everything, all the inputs. We think that this is also going to result in a softening of the annual sales volume in the U.S. as well. So I think it's dampening, he may be trying to dampen enthusiasm in Canada and Mexico, but the net effect is to dampen gross capital investment in automotive across the continent.
We did, of course, just renegotiate our trade agreement with this president in his last presidency. And autos were a big part of that. We actually made some gains, some would argue, in terms of the rules around content. What do we have to lose here if we're reopening up that agreement again, as it seems likely, ahead of schedule, and renegotiating, because the auto industry is really at the heart of our trading relationship?
The practical gain from NAFTA to USMCA was we went up in local content value. It used to be 62.5% of a car to be made in one of the three countries. It's now at 75. But we managed to negotiate into the content for the parts, the major parts, electric vehicle components, because we have this advantage in mineral and resource deposits. We thought it would anchor, of course, some of the big investments on batteries here. I think if the markets are moving in part because of intervention by the new administration away from that growth curve on EVs, we seek to lose that advantage. But at the core of it, what Trump wanted President Trump wanted in the first agreement was to bring that number from 62.5 to 85. He wanted to see 50 of that 85 be U.S. only. We Canadian, American, and then even for the most part Mexican auto part suppliers, if I did a Venn diagram of where our interests overlap, it's going to look pretty much like a circle. The question is, how high can he push local content if that's where he's going to go again, before automakers say, well, I want to import instead and pay the 2.5% tariff? I think he's answering the tariff penalty first before he draws us into those conversations. Canada could still do very well, but I think we need to approach that humbly. I don't think this EV transition is going to go at the pace that we've seen over the last 4 or 5 years. And we need to try to make sure that we get enough of the melted plastic and the poured metal parts, as well as some of the forward-looking applied technologies, connected autonomous battery chemistry stuff.
Flavio, good to have you for this. Really appreciate your time.
Always a pleasure. Thank you.
Coming up, like it or not, tariffs seem to be headed our way. We'll take a look at how businesses are coming up with the strategies they need to cope. Next. Welcome back. Small businesses are trying to make plans ahead of a worst-case scenario. That would be 25% tariffs on all Canadian goods that cross the U.S. border. It seems inevitable that they will suffer. Dan Kelly is president and CEO of the Canadian Federation of Independent Business. Dan, thanks for being with us.
Anytime.
So let's start with what you're hearing from businesses. There's a lot going on. Most of it's uncertain. So what kind of planning can take place?
Look, what we're hearing is most are operating under a hope and prayer strategy right now, hoping that this doesn't come to be, although the uncertainty alone is just so deadly. But what I'm hearing from most, I think almost half of businesses that are importing goods to Canada are from the U.S. are looking at alternative sources of supply. And of course, exporters looking at other markets to which they may be able to sell their goods. Lots of delays in expansion plans. These are some of the things that businesses are doing, putting stuff on hold and building contingencies for when we know more. And
is the government being supportive? Are you hearing that there are new programs or more visibility on programs helping businesses doing some of this stuff?
I wouldn't say that there's much in place right now, but I do know that there are lots of efforts being made to construct programs, supports, depending on the eventuality and what types of tariffs ultimately get imposed, if any. But look, I mean, at this point, it seems like uncertainty is its own enemy, and that is causing businesses to take some actions, including some to reconsider whether they want to do business in Canada or expand into the U.S. to get on the other side of the tariff wall.
Yeah, and I guess this is the time to try to persuade them to do the opposite, right? Trade more with other provinces instead of going south, in which case you'd hope to see some action on that front. Have you seen or heard any kind of shift in that interprovincial trade stuff that we've heard a lot of talk about, but that can be pretty slow moving?
You know what? I have to tell you, having followed that file for 30 years, I am more optimistic than I have ever been that we may finally get the breakthroughs that we need. We've been pushing for mutual recognition. Stop trying to harmonize every single rule and regulation. We'll be having our grandchildren do that work. But I can tell you the work out of Nova Scotia and then messages from Ontario, some rumbling that BC may join the fun, where they're going to mutually recognize each other's rules and regulations in one fell swoop. That is major. And if it comes to be, that would be a tremendous outcome for Canadian businesses from coast to coast.
We've also heard, of course, if the eventual bad news does happen, tariffs do come, that there will be some kind of relief packages. I know the government doesn't want us to say pandemic era packages, but that there would be money flowing. Is that enough to keep businesses from losing all their confidence right now?
Yeah, well, look, it is good that they're at least talking about this, but there's lots of things that, of course, we don't want them to do. I sure don't want to see a repeat of the CERB program, which took thousands of workers that otherwise had jobs and had them sit on the sidelines for up to 2 years. But yes, planning is happening, and businesses certainly need to know that that is in the works. Hard to see exactly what the nature of those programs would be.
Dan, so good to have you. Appreciate your time.
Anytime.
Dan Kelly, President and CEO of the Canadian Federation of Independent Business. Canadian steel manufacturers, of course, are bracing for the potential tariffs that could come as soon as next week, including rushing to fill orders before those tariffs hit. Matt Ion is the president of Timberlea Steel. Matt, thanks for being with us.
Thank you.
So let's start with what you do in the face of what could be, of course, debilitating tariffs. What's your plan of action right now?
Well, for the last several weeks, it's been sort of a moving target. The tariffs are on, they're off, they're on, they're off. So we've been pushing quite a bit of metal to protect some of our U.S. customers into the U.S., getting them into warehouses and cutting facilities that we would use in the local market to facilitate those future orders and protect a month to 3 to 4 months of supply to those customers. So that's what we've been doing. And that's been across the board, I think, at the service center level and at the mill level. There's been a big push in the last 3 weeks to ship as much steel as we can across the border to limit our exposure of the potential 25%, we don't know, tariff.
And, to that point, you're sort of trying to get ahead with as much, say, weeks or months inventory in advance. Is it the hope that this passes? In other words, even if tariffs come, you've satisfied your customers for long enough that if we can negotiate our way out of it, everybody will be okay?
I think that's everybody's thought process, but nobody really knows. Again, yesterday, I think there was some interaction that maybe it wasn't on Tuesday and that it was moved till maybe April, and then it's March 12th. But yes, to answer your question, I think we're trying to mitigate that exposure of the tariff and try and get or satisfy our customers in the U.S. for a period of time, and whether that's 2 weeks or 6 weeks or 6 months. But that's our game plan right now.
I know I didn't realize this until I started looking into this, to be honest, Matt, but this is an integrated industry. Steel crosses the border multiple times in many cases, as we see in the auto industry. That may not be the case for you, but because it's so integrated, does that change the pressure from the other side? Is the U.S. government going to hear from a lot of American businesses that are in the steel industry?
Well, that's what I've been sort of hoping for the last, call it 30 days, that we've really been hearing this pressure of the tariffs, that there would be quite a bit of pushback from the Americans. But as of right now, it seems that the tariffs are going to go through, and we're going to have to figure out how to deal with it. And I think that's been the biggest thing, is that some of the Canadians now have been saying, listen, if it's going to happen, let it happen. Let's figure it out, and then let's move forward. Right now, there's so much uncertainty to when it's coming, if it's happening, and how to prepare, and basically how to move forward, dealing with our greatest trading partner, the U.S.
Yeah, that uncertainty has to be the worst. And I guess that's the big question is, do you, as a business leader, plan for the worst case scenario? In other words, a new era of tariffs, maybe not 25%, but certainly not what we've seen in the past.
I would definitely probably agree with that statement. I think we're, me as a business owner, I'm looking at, again, sourcing more steel out of the U.S. to supply to our U.S. customers, based on the fact that maybe this tariff's in for a while. Maybe it's 25%, which I think we could handle in the commodity side of things with the currency and offsetting some of those things. But if it's more than 25%, there probably wouldn't be much of a market from Canadian steel down to the U.S. So trying to find some supply. But in the last several weeks, the U.S. mills, their order books have been filling, and they're, some aren't quoting, some are booked out till May, June at this stage. So it's becoming a challenge.
Matt, so good to have you for this. Appreciate your time today.
No problem. Thank you so much. Matt
Ion is president of Timberlea Steel. Coming up, the Canada Infrastructure Bank is rolling out investments. We're checking in with the CEO for the latest. That's still ahead. Welcome back. After a slow start, the Canada Infrastructure Bank is picking up steam. Here's a look by the numbers. The CIB was founded in 2017 with a mandate for up to $35 billion in investments aimed at mobilizing private capital in infrastructure. After what seemed like a slow start, the bank now has 79 infrastructure project investments. That includes 58 under construction and 5 already complete. The value of its current investments is $13 billion, spread across the country and attracting $13.1 billion in private capital. The bank has 5-year targets of investments in key areas. Those include public transit at $5 billion, clean power at $10 billion, green infrastructure at $10 billion, broadband at $3 billion, and trade and transportation at $5 billion. They've got a target of at least $1 billion in each sector that will benefit Indigenous communities. The CIB says that since inception, its investments have boosted GDP through construction by $22.7 billion, created 165,230 jobs, added broadband access to 434,900 households, and upped daily trips on transit by 174,000 riders. Aaron Corey is the CEO of the Canada Infrastructure Bank. Thanks for being with us.
Thanks, Amanda. Nice to see you again.
So it does feel as though the pace of deal making has really picked up. So whatever's happening, does it feel as though you're on a roll, that you've figured out sort of whatever the magic formula is to get the private capital to the table?
Yeah, I think you're exactly right. It did take us a bit of time to figure out how exactly do you marry the project priorities of the country and the return expectations of the private sector. And I think we've done that. And as you say, now we're a going concern, and we're week by week making new investments across the country. So yeah, it feels very different than in those early days. And I think we have figured out sort of the formula for success.
You also have, as we noted, this commitment to Indigenous infrastructure. When we think of the infrastructure deficit in Canada, it's a big one. The Indigenous infrastructure deficit is also big. What's the role that you hope to play there? What are you doing in that space?
Two things, and I'm really glad you asked. Almost a quarter of the investments we've made, you mentioned the 79 in total, almost a quarter are in participation and in collaboration with Indigenous communities. And there's really two goals. One, the infrastructure gap in Indigenous communities is even larger than it is in the country at large. So water and wastewater systems, basic road access, certainly broadband, all of those infrastructure asset classes you mentioned, the need for investment in community is even greater. So we've got 15 of our investments that are in community, getting those core infrastructure needs met. But the other thing we've been doing, and there's more and more of this, is more focused on economic participation in infrastructure. So think a wind developer building a new project in Indigenous traditional territory, bringing Indigenous partners to the table as equity investors. So we've started making loans to the Indigenous communities so that they can buy a stake in projects that are in their backyards. And so the goal there is for them to be economic participants in the infrastructure that we're building, as well as reaping the benefits of it.
Which is, I mean, we noted that in other areas, the CIB has, along with, funding for projects that might not otherwise get funding, so making things attractive for the private sector, a kind of a social good aspect to it. You have sort of a reach that goes just beyond a sheer return. How do you marry those two things so you make sure that you're still focused on the return, but also achieving these other kind of agenda items?
Well, I mean, this is the whole idea of what we call blended finance, that we are here as an investor on behalf of Canadian taxpayers, and we need to earn a return. We need to get interest. It covers our costs. It covers the risk that we're taking. But we're not in a profit maximization world. So the way we look at every loan is, are we going to get paid back? Are we going to be able to meet our hurdle rate financially? And what's the impact? And you talked about this in your intro. We look at impact in terms of new homes connected to broadband, new home starts because you put water pipes in the ground and homes can get built, new transit ridership, new access to electricity. So we measure those impacts, and we actually have just like any investor, we have a hurdle rate, both financially but also in terms of impact. And if two projects came to us, one that would get 1,000 new homes started and a different one that would get 10,000 new homes started, we would put more money into the latter. So we try and bring the same disciplined investor approach.
Yep.
Both on the financial, but also on the what we call the public impact goals. And I think that's the secret formula that we've landed on.
Not a ton of time, but there is renewed interest in infrastructure in this country for a whole bunch of reasons, but tariffs are one of them, right? Our relationship with the U.S. is high on the list. Has that changed the urgency around what you're doing?
Well, I think there are some real opportunities for us. It's a very uncertain world, and you're right. It's a big challenge, but the opportunity for us to invest in the infrastructure that's going to make us more prosperous and more competitive. And I'm talking about building out our grid. So we have, because low cost, reliable electricity is the lifeblood of many of our industries. I'm talking about trade corridors and ports so we can get our goods to markets around the world and be prosperous. Some of those infrastructure, trade and transportation and energy are going to be more important than ever. So I see that as a real opportunity for us to invest in the stuff that's going to make us competitive and prosperous for a lot of years to come.
Aaron, so good to have you for this. Really appreciate your time.
Thank you. Always a pleasure, Amanda.
Aaron Corey is CEO of the Canada Infrastructure Bank. Time for the takeaway and a housing problem that continues to build. In case you thought it was your imagination, the situation for housing in Canada really is that bad. The OECD recently released global data on the ratio between incomes and house prices, a measure of affordability, in other words, and it doesn't look good for Canada. In fact, of the 38 countries of the OECD, Canada ranks second worst for affordability. In the past 10 years, the gap between incomes and house prices has increased 37% here. Only Portugal's is worse at 58%. The U.S. isn't far behind us. Homes there got 30% less affordable since 2015. Compare that to other advanced nations like Germany's 7% increase in prices relative to incomes, or the UK's 5%, and it starts to look like we have a real problem. Places like France, Italy, and Sweden all have declines in the ratio, meaning housing is more affordable today than 10 years ago based on incomes. As for Canada, the problem isn't with incomes. They've risen over the past decade here, and they continue to do so. The problem is well known. We don't have enough houses. And based on recent housing starts data, that picture is not improving nearly fast enough. Starts were down 2.5% in January based on the 6-month trend. And the housing regulator isn't expecting any big jump in construction in the next 2 years. That's a staggering phenomenon given all the talk about trying to solve our housing problem. The real issue is getting more homes built faster, and yet developers are seeing longer delays for approvals, not shorter ones. And the fees associated with building are going up, not down. All of that makes you wonder if everyone even agrees this is a problem we need to solve. My takeaway? There are a lot of things Canada should lead the world on, but housing that its citizens can't afford shouldn't be one of them. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.